The fourth quarter 2023 earnings season has begun, but many analysts say that the mood going into it was just meh. Our research director, Shiraz Mian, is here now to let us know if that's how he saw it. Shiraz, do you agree with that assessment? And if so, why?
I don't, Terry. And the reason is, as I'm sure you have heard me say many times in the past, that earnings is one of the two most important things that drive stock prices. Interest rates being the other factor, and every earnings season gives us fresh color on the broader earnings picture. So every earnings season is very important. Q4 earnings seasons every year are even more because it sets up the outlook for the coming year. And there's a lot of big picture questions about the coming year, about this year, about 2024. I keep forgetting we are in the new year already. So that's the reason why I don't believe that it's not important. I do understand, though, why some people may think it's not that important. They may feel that those doom and gloom questions about the earnings have been answered now. That there is no earnings cliff on the horizon. And the bigger questions in front of us are more macro and central bank related and not related to corporate profitability. So that's probably why people think what you described. But as I said, I always believe earnings seasons are very important for anyone interested in stocks and in the stock market.
Well, analysts have cut their estimates by more than usual going into this reporting period. Does that concern you?
Yes, it does. Though the more recent development on that front, Terry, is relatively encouraging. I noticed that since the beginning of Q4, there was a notable deterioration in the earnings outlook. So the revisions trend, if we step back from Q4, the revisions trend had significantly improved in 2023. And we saw a decent amount of upward momentum in Q2 and Q3. So at the start of Q4, I started noticing and wrote about it as well, that estimates for Q4 as well as for 2024 had started coming down. And this continued in October and November. But by around mid-December, the revisions trend stabilized, and then that stabilization trend has continued in January too. So it is concerning that estimates came down so much, though I've been encouraged by the recent stabilization on that front.
Do you think the Q4 results are going to be an important test to tell how companies are thinking about the macro backdrop and if we avoid a recession?
Absolutely. I think it's going to be absolutely essential. Obviously, we get the macroeconomic data, the high frequency data about the economy, but what companies say about their own industries, sectors, and then their own businesses is absolutely essential in getting a gauge of the U.S. and the global economy. So yes, it tells us a lot about the health of household finances, about spending trends, and generally the outlook for the recession, the soft landing, hard landing debate, and this earnings season will be adding to our understanding on that key question.
The big banks and other financials kicked off this earnings season. The banks seem to come in a bit mixed. What do you think about how they came in?
Yes, they were mixed. Some of these banks had a bunch of issues and had to make reserves. Citi had a very noisy quarter. But on the whole, I think results came in as good as one could expect given the macro uncertainties. And to your earlier point about the outlook for recession and the economy, I think they were very useful in giving us visibility on that front. Most of them had favorable things to say about the economy, about the outlook for consumer spending. There was no reason to be overly concerned and worried about those recession questions. There's some weakness in spending and on credit quality. Nothing unusual, nothing beyond what most of us were expecting already. So on the whole, I think the bank and the broad finance sector results were good enough and gave us a good read on the big picture as well.
All right, we're sitting here talking on January 18th, so this earnings season is still kind of young, but have there been any standouts so far?
We have about 45 companies have reported, Terry. So yes, you're right. It's still very young. The sample of results are more weighted towards the finance sector. Companies are easily beating EPS estimates. Earnings growth is tracking roughly in line with what we have been seeing in recent quarters. If there is one area of divergence from this otherwise reassuring and positive picture is on the revenue side. There is a decelerating trend on revenue growth. That was a trend we had been seeing for the last few quarters as well. So the growth deceleration is continuing. And then a more notable development I'm noticing at this early stage, Terry, is that a very small proportion of companies are able to beat revenue estimates. Now, granted, this is very early and this could change, but if this trend of companies struggling to beat revenue estimates persists through the remainder of the Q4 earnings season, then this would be a change from the trend we had been seeing in recent quarters.
How important is corporate guidance this time around?
Very important, Terry. So it goes to the crux of all of us that are involved in the market to get a handle on what's happening with individual companies, with individual industries, and then the broader economy. So it adds to our understanding of the macro developments. And then on top of that, to the earlier point you were making about earnings estimate revisions, guidance will determine that. So as I referenced earlier, the doom and gloom kind of narrative has taken a backseat, and we are now firmly in 2024. So it's the outlook for 2024 and beyond, which is very positive and very strong. And the concern is that those estimates will need to come down. Guidance will determine whether those estimates come down, and if they do, to what extent. So yes, guidance is very important.
A lot of eyes are going to be on the Magnificent Seven stocks going forward. How important are those results going to be from those companies regarding especially those companies maintaining market leadership?
Very important, Terry. As you know, the market's strong gains last year were primarily driven by these companies, and these companies have been on a turnaround in their individual businesses as well. The last couple of years were tough on these companies, and the narrative that took hold was that the last couple of years of weak profitability and growth was basically an adjustment from these companies to the very strong COVID gains. And 2023, particularly the second half of 2023, saw these companies come back very strong in their top and bottom line outlook. And it's essential for that performance momentum to continue, that the earnings and the profitability picture for these companies continues to improve. So yes, this is a leadership group. These are companies that are extremely profitable, and we need to see, the market needs to see that what these companies achieved last year was justified and will continue in 2024 and beyond.
So is it too early yet to go out on a limb and maybe predict what earnings growth is going to look like this Q4?
So to your earlier commentary about estimates having come down more than normal for Q4, we started out at the beginning of Q4 around 5-6% year-over-year earnings growth. By the time this earnings season started, we were barely negative territory, 0.5, 0.6 on the negative side. And we are now essentially flat. My sense is that when all is said and done, we'll be somewhere in the middle, perhaps 3-4% year-over-year growth. But it's too early. There's still a number of moving pieces, and many industries and sectors have yet to report any results. So it's hard to tell at this stage. But my sense is perhaps low single-digit earnings growth when all is said and done.
All right, that's our research director, Shiraz Mian. I want to call everyone's attention to his written commentaries on Zacks.com, and you can access those right off the home page. With Shiraz, I'm Terry Ruppolo. Here's something you can check out as well. It's a free book, Finding Number One Stocks, and in this 300-page hardcover, Zacks Executive Vice President Kevin Matras reveals almost every stock-picking secret he's learned from the system that since 1988 has more than doubled the average yearly gain of the S&P 500. For more details, go to Zacks.com/promo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.